A little word of explanation. I have actually retired from LaSalle and have no formal connection, but after a fabulous 20-year career with them, I still am very happy to use their logo and, in a sense, in a presentation that I first did just over 2 years ago, just before I retired properly. And what I wanted to do was share with people my experience of really property cycles through a career which lasted a little over 45 years. And so that is what I have chosen to talk to you about today. I should, before I say anything else, thank you very much, Michelle, and sorry that Ingrid is not here this morning, but thank you very much to ESSEC for inviting me to give this keynote address at Aries. I thought I'd been to my last Aries conference last year, so always delighted to come back again and see so many old friends from around the world. So thank you very much for that. Now, when I've been here before, I've talked a bit about Brexit, and I had thought that I might try and not tell you what's going to happen, because nobody knows, but try and explain why Britain is making such a mess of things, or why we want to leave, or some people want to leave. But frankly, it's both very difficult, and it's also pretty depressing. So I think we won't talk about that, but hopefully we will have some time for some questions at the end, and if you want to ask me, I will do my best to answer. So what I am going to talk about is property cycles, and I've broken the timing down. The past starts or runs up to the end of 2013. The present, in a sense, what might be determined or called the current cycle, started in 2014 until today, and then I'm going to talk about the future, and then which will include my explanations for what has been the key drivers in relation to the property cycles, and in a sense then talk about, well, when will the next one be? What was I going to say here? Yes, I mean, I'm afraid this is the data is pretty UK-centric, but not exclusively, mainly because, well, we have the data, which isn't around elsewhere. But let's work on that as we go through. So the past. It's a little bit the story of my life. 1968 was the year I went up to university. And so that is the data series we're looking at. This is real capital value change annually for all property. An amalgam, this is a mix of MSCI IPD data and some JLL LaSalle data that from about the mid-70s earlier. And this looks a little bit like my heart monitor. My heart is not perfect. It's pretty good. I'm not going to fall over today, but it looks a bit like a heart monitor. But what we're more interested in is the cycles. And so I started work in a firm of commercial surveyors that some of you will know called Gerald Eve in 1971, and just arrived in time to see the boom and bust of the early 70s. Then, by the time we got to the 80s, I was actually an equity partner of Gerald Eve, even running head of their investment department. And then for the GFC, by that stage, of course, I joined LaSalle and was very much part of that. So this, in a sense, those three cycles have pretty much been sort of seared into my memory in terms of what I've learnt. Now, property cycles. I think they are endemic. Property is always going to be cyclical, but in a way you need some data perhaps to emphasize that. If we look at Australia and the US, which have the next longest series, certainly since the sort of the mid to, well, from 1980, there are some similarities. Certainly there was a downturn in the US and Australia, as well as the UK in the in the early 90s, and everyone saw the rise and fall in the GFC. The way the US market worked in the 80s was a little different. Their sort of big increase in values was a bit earlier. They were static and didn't rise and fall, rise rather, they certainly fell in the early 90s. And certainly here in France, there was a pretty bad property crash in the early 90s as well. But if we look at office markets, CBD office markets, some data that was put together by Paul Clark of PMA from markets around the world. CBD offices, probably the most volatile bit of the market anyway. We can see that there is a lot of volatility everywhere. Sometimes the markets are pretty synchronized, as they were in the GFC. Other times they're more idiosyncratic, if you like. The yellow line, I don't think the pointer I can do much with that. But if you can see the yellow line all on its own, the boom, that is Singapore in the mid-90s. And the crash was when the Asian crisis hit in 97, Malaysia and the like. The line with dots on it is the City of London. And in that context, London does not look that volatile relative to other places in the world. But so how volatile markets look can be deceptive. But let's go back, if we may, to the UK. So in the mid-90s, about the time, it was between Gerald Eve and LaSalle as far as my career was concerned, I read a book by a guy called Paul Ormerod, who some of you may know, who wrote a book called The Death of Economics. And he suggested that when you're faced with something that's cyclical, decompose it into its component parts. So that is what I chose to do. And I think I did show this slide in Bucharest to a small group in 2013. I certainly know at least one person who's here who's seen that. I don't know how many others, but whether you remember. But what I'm going to show you is we're going to plot on this chart what happened in the market in terms of real capital growth and rental growth. To decompose it. Now, the 45-degree line is significant in the sense that if you've got a data point to the south east of that line, as that first red dot is, that is a year in which yields are compressing. Yields are going down, pushing up values more than rents. And of course, a data point northwest is the reverse. Yields are rising, pushing down capital values. A data point on that line is when you have got a year of no change in yields. All the change in value is due to rentals. So in 1968, the year I went to university, we had a 5% real capital growth, which is a very strong number. Rental growth, though, was perhaps 0.5% real. Again, these are all inflation adjusted. And so in 69 and 70, we're starting to see strong rental growth, but actually yields moving out ever so slightly. 71, the year I started work, strong rents, yields actually moving out a little. And then in 72 and 73, we had very strong capital growth, when you're seeing capital growth of over 10%, I mean, that is very strong. And 2 strong years, really a boom year. 1974, not many of you will remember, but in the UK it was a disaster. We had 2 elections, we had a 3-day week, power cuts. It was a complete disaster following the Yom Kippur War and the increase in oil prices, and the market collapsed. And so we see this extraordinary collapse in values, less so in rents. But a recession followed, and we had 2 very bad years of rental falls, really causing the decline in value. And then we get to 77 and 78, and the market has bounced back very strongly in value terms, but not rents. Rents rising just a little. This is all about a yield movement. And then the market settled down, and we have quite a long period where the market was pretty stable, declining ever so slightly. In truth, it had got overvalued, and the institutions were much preferring to be in stocks than they were in property. And then in 1986, I hope I've got that one right, rents started to rise quite sharply, particularly in the City of London offices. And in 87, we had a very strong year, and also in 88, really the start of a new boom. So the colors changed. We're into the new cycle beginning with a boom. And then in 89, the market retreated a little. And then 1990 was a year of collapse, not quite at the scale of 74, economic downturn pretty globally. We then have 2 years where the economy's in a bad way, rents fall, yields pretty static. And then in 93 and 94, the yields bounce back, they're forced down, even though rents are still terrible. And then in 95, the market moved, was quite negative, and yields had overshot a little. And then we got to 96, almost the nearest to the point we've got to the origin so far. And 97, the year I joined LaSalle, the market looked pretty strong. People thought we were going to go into a boom. Were we going to? We didn't. The market pulled back and was quite strong, but not really out of control, around about the 5% sort of real level. And then we're in 99, 2000, 2001, post the 9/11, the markets went into retreat, both on the rent side, particularly on the rent aspect, less so on yields. And the markets, again, occupier side, not so strong, but the capital markets were getting increasingly strong. And in 2004, we had returns in the marketplace nominally of about 17%, all about yield shift, nothing to do with rents. And we had 2 more years like that, so 2004, 5, and 6, all very strong, very much pushing the market, nothing to do with rents, all to do with yield movement. And then in 2007, as the global financial crisis started to hit, capital values, yields started to rise, rents quite strong, probably the strongest occupier market of the decade. But then you got to 2008 after Lehman's had dropped and the market went down even more. But by 2009, the yields had stabilized, even started to come back a little, but rents are now in free fall because the economy's in a mess. In 2010, again, the yields are pushing down quite clearly, even though the occupier side is poor. And 2011, we're getting to some stability again, 12 and 2013. So, what has all that told us? Well, clearly you've got 3 booms, 2004-06, the other ones were for 2 years. You've got busts, 3-year busts, pretty clear. But the most interesting bit is the recovery. In each of these following the bust, there has been a recovery quite sharp, quite pronounced, 77 to 78, 93, 94, and then in sort of really in 2009, 2010. I mean, in fact, a time when values move as quickly as at any time. And then in between time, effectively, you have, in inverted commas, equilibrium, where the market moves broadly within a sort of plus or minus 5% area. Now, we can just sort of to emphasize the symmetry and how these cycles have just played out. The three booms each show an increase in value of around about 30%. The busts, the fall is a little bit more, around almost 40% or very close to it. So over a 3-year period, the booms over a 2 or 3 year period, and then the recovery, you're getting about a 10% increase in value, bouncing back from the low. Now, normally, rents may sort of do something sensible. You can see that rents increase very strongly, particularly in the 1980s, but also in the early 70s. In the last, up to the GFC, rents barely did anything, hardly went up. In fact, really, in real terms, they didn't. But when the bust came, they didn't go down very much either. In recoveries, rents are falling in all three cases. The recovery has nothing to do with the occupier side. It's all a capital market play. Okay, well, what else does this tell us? One of the important things to me was, in being in the market post the GFC, was that what happened, certainly in the UK, was not exceptional. This was just one of a big one, serious one, but it was a periodic boom bust that comes along. The fact that it was roughly 17 years since the previous one, and the previous one had been 17, it was a 17-year gap as well, is that just a coincidence? Well, it may be, but in economic literature, there has been identification of cycles on a long basis, different types of cycles, for a long time. And many of you will be aware of the names. I mean, and probably Juglar's business cycle is the best known and still really one of the most important, roughly round about the 10-year period. When did Juglar write his paper that identified business cycles? 1862. And then most of the other work on cycles, the shorter cycles, is really in the 1920s or 30s. So this is not new stuff. This has been around for a very long time. But in a way, because there has been no formal explanation within it, I think economists don't take as much notice of it as they should. I mean, particularly if we come into property, Kuznets in investment, infrastructure investment cycles. He wrote about that in 1930. American Foldbury has identified 18-year cycles in US property that go back to the 1810s. And Richard Barris's work, who some of you will know as the founder of PMA, we'll come back to Richard, written a brilliant book on building cycles. And he's identified cycles in London, in buildings certainly to the early part of the 17th century. Subsequent to that, he's gone on to create what is effectively a coffee table book, where he talks about creating the palaces of the day, well, the palace of today being, rather sadly, a shiny office block. or perhaps it's now a residential tower. But in the past, it was cathedrals or castles or mansions outside. And he's identified cycles really in those as well, really dating from about 1000 AD. So cycles are really endemic in property, and we shouldn't be so surprised about all that. And the other side of them, they make some pretty good stories. And books have been written about each of these cycles. John Plender's book, That's the Way the Money Goes, is a very good read. John is still a Financial Times journalist, and we'll come back to him. Alistair Ross-Gooby wrote Bricks and Mortals. Alistair, sadly, no longer with us, very famous fund manager. And we'll return to him too. And I'm sure many of you have been to see The Big Short about the GFC. These make some pretty cracking stories. So that's the past, in a sense, to 2013. Let's move on to have a look at the present, in a sense, the present cycle. When I first gave this presentation, I say it was in 2017, the first part of 2017, after we'd had 2 years. So in blue, you've got the extension to my heart monitor chart, if you like. So we've now, for sort of this cycle, we're in 5 years, really 2 years of very sharp increase in value, 12% rise in 2014, 8% in 2015. But since then, really very little real capital growth, and in fact, it's really flirting with negative territory. Obviously, 2016, there was a Brexit effect, which slight recovery from in 2017, but last year, 2018, values declined again. Clearly, some pretty tricky things are happening on the occupier side, especially with retail property, not just in the UK, but worldwide, which is having a negative effect on values. Obviously, warehousing is doing rather well. But of course, the warehousing sector is rather smaller than retail, so within the overall, that negative force is at play. A lot of people have been concerned with what is happening in this cycle, and are we going to have a repeat of 07, 08, 09? And certainly when you look at transaction volumes, there is a little bit of evidence that the market hit a peak in 2015, and since then, transaction volumes have been down. We're all right behind. Good. Sorry, a little bit of flashing of screens going on here. So there's some evidence that the market has slowed, but fortunately, it has not slowed quite as dramatically as it did in sort of the transaction volume you were seeing in 2009. We haven't got to. But there's some cause for concern. Transaction volumes are not at the level they were. What happens if we look at the increase in value compared with what we have seen in previous booms? Well, a 20% increase, 21% increase in real terms in 2 years is pretty good, but it doesn't quite make the mustard in terms of the historic booms that I've lived through before. Now, how can I make any conclusion from that? With difficulty. I mean, this is pure chartism, technical analysis, but it would appear, and how one explains it, I've no idea, but the juices in the marketplace have not been revved up, I would say, quite enough for a boom of that level to create a bust. Now, that's all conjecture, that's not academic, that's not, but there's the challenge in a sense. I mean, of trying to understand cycles, is there something there that would actually help us? And then, in a sense, is why might there have been a boom in values of the order that we've seen? Well, when we go to other assets, that story becomes more obvious. In a sense, the challenge most people with a capital asset pricing model, what is the starting point? The risk-free rate. Now, rather than using 3-month treasuries, sort of in real estate, we tend to use 10-year bonds, and that is what I'm showing you here. This is the 10-year UK gilt, which over this 40-year period has been anything but stable. In fact, it's done nothing but go down. And still to today, currently the yields in the marketplace are at about 0.8%, 80 basis points. And of course in Germany, I think we're on about negative 40 basis points currently for 10-year bonds. So this in a sense is not unique, but coming off the very high inflation of the 70s, these bond yields have just gone down. Now, in a sense, this is pretty extraordinary. This is what we're meant to be pricing all assets off, and it's, has done nothing but go down. We've been expecting some mean reversion here for most of the decade. There's still no sign of it actually happening. When we look at the stock market, that has been a little bit more stable, but certainly yields on the stock market went down from the beginning of the period to 2000. Since then, they've tended to rise, and still they're about stable at 4.3% today. What's property been doing? Well, this is the old Hillier-Parker all property yield that starts in 1975. And in a way, that's rather more stationary than the others in terms of the trend on that looks rather flatter over this period of time than the other asset classes, oscillating sort of round about 6 to 6.5% as sort of the average. I mean, currently it's probably getting close to 6% again. The year end, it was 5.8. But if we look at probably the hottest part of the market, the West End, which does show a slight downward trend over the period, I mean, that's stable at 3.5, 3.75. Today, interestingly, pretty close to the dividend yield, which it's flirted with, and when you go back to the early 1980s, again, when property yields look pretty low. And lastly on this, I want to just put on the gilt yield. This is our index-linked, so what you're getting is the retail price index, the inflation measure, plus the nominal amount. When these bonds were first issued in the 80s, you were getting 3, even 4% positive. Today, they're priced at -2%. So you're not getting inflation off these things at all. Now, there are a number of reasons, perhaps I won't go into it, why that is. But when you look at what has happened to those nominally risk-free rates, the gap between them and property is pretty wide. And so it's not surprising that property yields were pushed down at that period, and as they have been not just in the UK, and in fact they've moved up a bit because of Brexit concerns, but in the rest of Europe too. So we have that as a challenge. But if we use a little bit more history, we see that this period we're in is just completely exceptional. The British government started to issue undated bonds in 1700. So we've got 300 years plus of data here. They now paid them all off in 2015. But you can see that the post-war period is completely aberrant. But you can also see that a yield below 2%, historically, prior to recently, was unheard of, whole of that period. So at some stage, one would expect there will be mean reversion. But clearly, if you know when that is, you will be very rich. So, how are we doing? Reasonably well. Let's go and look at the future. What drives these property cycles? What else? And we're going to look at the economy, we look at development, we're certainly going to talk about credit markets, and we're going to talk about behavioral economics, a bit of psychology, and what I think is really quite important, the role of memory. So if we add to my heart monitor chart of the property returns index that you've seen, if I add UK GDP, you can see that there is quite a correlation. I mean, it's over 50%. But really, so what, Robin? You may well be thinking, we know that the economy is very important in driving the market. But if we look a little bit more closely, and we identify the big cycles, or rather the big recessions that have occurred in the post-war period, you can see that in a way the big property cycles occur every second business cycle. So that, yes, in 74-5 there was a big crash in property and in the economy, but in 80-81 the property market wasn't brilliant, but it certainly didn't collapse. The economy was very weak. 1992, yes, property and the economy both weak. 2001-2, the UK economy was not that bad, nor was the property market. Globally, it was rather worse, particularly in the US, and then, of course, we've had the GFC. So that while the economy is clearly important, it's clearly not the answer to what we need. So what else is going on? What else do we need to be looking at? Well, firstly, development is the obvious one, which is in the real estate market. I need to thank Stephen Devaney, who is due to be here, although I haven't seen him, for this particular chart, which shows increase in office stock nationally. A lot of that is in practice in London. But you can see the boom in the early 70s, the boom which peaked sort of in the early 90s, late 80s, early 90s, and then office around the millennium, and then again in the GFC, smaller sort of spikes, and volatility, and particularly the market falling off quite sharply in our big cycles, so in the mid-70s, the mid-90s, and then post the GFC. Now, those changes in output have a pretty damaging effect on economies, as is pretty obvious. So clearly, development is a factor in these markets, but has been less so in the last cycle. And in a way, that is due to improvements in property forecasting, that people have some idea of recognize the supply process takes time, and I think that some of that we're not having quite the boom and busts in the supply that we have had, are due to the work that effectively has been done in this room, or certainly the origins of it, in terms of having a better understanding of what is going on. We will always have some volatility. I mean, there's more than just the straight economics. Being a developer requires confidence, and so when you look back, when were all the skyscrapers built? They were all conceived in booms, often completed in busts. Probably most famously, the Empire State Building was completed in the early 1930s, and I believe for many years was known as the empty state building. Things don't change that expect. So development clearly is relevant, but it was probably not the most important thing in the GFC. What else is there? Well, there's debt. The growth of bank lending to commercial real estate. This is actually a chart taken from a paper on commercial property and financial stability that was written by people at the Bank of England in 2013. And they're showing bank lending to real estate as a percentage of GDP. The blue part is the commercial banks. The yellow are the insurance companies, and the purple are building societies like savings and loans in the US, sort of mutuals, which were allowed to invest in commercial property in the 1990s for the first time. And those lending peaks, particularly by the banks, roughly coincide with the peaks we've seen in our property market, the booms and the busts. But certainly one well-known econometrician sort of saw this and said, well, Robin, but they peak after. What's the causality here? What is going on? But certainly, as a participant in the marketplace, I certainly think debt does play a very big part. And this chart, which I won't, is a picture out of Richard Barris's book, really explaining the interlinkages and what goes on and how the market is driven. But really, all I'd really want to take away is there are real economy effects on the left-hand side. On the right-hand side, you have the capital markets. And really, what the capital markets are doing are just amplifying the volatility and making the whole process more volatile, both on the way up and on the way down. And of course, that property cycle is on the way down. The collapse in things like development are having a very negative effect on the economy. So going back to this chart, going back to the economy, it's no accident that the worst recessions usually coincide with busts. And in fact, because of that feedback loop with the property market on the economy itself, and the Bank of England reckoned that a 10% fall in commercial real estate values leads to a decline in property values of 1%. So we're coming to the nub. Why do banks, and I'm going to say this, why do banks tend to lend too much and cause property busts, booms and busts? Well, this next chart, which was in this same 2013 paper, to me gives a good clue. What's it showing? On the y-axis, we've got the margin, or the loss ratio, what the banks have lost on average from different types of lending. The dark blue bar is to private non-financial corporations, general market lending. And the light blue is to commercial real estate companies. So that we see for the private non-financials that lending losses in the mid-90s, post the early 90s bust, were quite high at sort of 2 to 2.5%, and then gradually came down in the noughties to about 0.5% before climbing quite sharply in the global financial crisis. And about 0.5% loss, so in a way, is about as good as it gets for general financial lending. Interestingly, that's also about what you'd expect on an institutional rent portfolio, that you probably lose about 0.5% if in a well-managed, in a well-managed portfolio. But when we look at the commercial real estate loss ratios, in the run-up to the global financial crisis, the loss ratio was as near negligible as you can get. Now, property also is quite attractive to bankers because you can lend quite a lot of money in one go on it, and it's relatively simple. So that if you have no memory or no knowledge of the cyclicality of property, this looks too good to be true. Well, sorry, it is too good to be true, but it looks really, really attractive. So you're into that classic situation of why lenders want to increase their loan books. And of course, they increase their loan books by reducing margins and by probably lending to people they shouldn't, and widening it out in different ways. And then, of course, it all goes wrong in the bust. And remember, importantly, most of this lending is non-recourse, i.e., the only security for the bank is the property value. The individual who was, or the corporation who has taken out the loan is not going to pay up. I mean, in practice, these are single-purpose corporations. The only asset in the company is the property, the way it's structured. So it may be part of a large group, but that doesn't matter. There will be no support for it. The only security for the loan is the property. Again, something that the banks all too frequently seem to forget. This is the same sort of data for US commercial mortgage-backed securities. Again, we see, you probably can't see it, there is sort of a right-hand chart which shows the volume of lending, which peaked in about 2008 at $800 billion worth of lending. But up to 2008, very few losses indeed on these loans, and then the losses explode. And so that by 2010, really about $60 billion worth of these loans were in default. So very nearly 10%, right the way across the piece. Really pretty serious stuff, very similar to what we saw in London. Prior, this looks like a very easy, good business. Suddenly, all changes if you're not aware of the cyclicality that property is. So what lessons have I learned from these three big cycles? Firstly, that debt-driven real estate markets are dangerous. Debt is a four-letter word. That has been, it is clearly beyond a level. Initially, you need it in a marketplace, but beyond a particular point, it takes the market to levels that are really very dangerous. There is a contradiction between prudent lending and building a market-leading banking business in commercial real estate. Classic conflict, I mean, in a say, with all lending. And how that is managed is really critical. And of course, it always has surprised me about how little banks, or certainly the UK banks at least, invest in understanding what is happening in the real estate market. Yet 60-70% of their loans are secured on on real estate. I think it is really pretty shocking. I mean, that is how that relationship works. Too much development is also dangerous. We've seen, other examples, I guess, if you were involved in the Spanish residential market in the last decade, loads of building there, eventually it goes wrong. I'm sure that there are other examples people will think of around the world. Sorry, Paloma, I wasn't having a personal go at you. There you are in the front row. The other area which has fascinated me is this question of greed and fear. Greed and fear, the sentiment around what drives investors when they are confident or overconfident, or just plain scared, and how that is highly volatile, that psychological impact. I think everyone needs to pay attention to behavioral economics. Quite an interesting piece by Tim Harford, who some of you may read in the Financial Times or other areas, writing at the weekend. And he was really talking about how it's so much easier to get papers published in academic journals when you've got hard data with an econometric analysis on it. Those are the papers, which appear scientific, which get into the refereed journals like. But there's a limit to what you can do with that sort of data, to my mind, in terms of how much you can learn from it. We certainly need to pay attention to the softer side. And behavioral economics, to me, has a huge role here. I'm far too old to get into that. That's for you to tackle. But there's a huge opportunity there to make that much more meaningful and gather it in different ways. Property looks a very easy business in a boom. We saw those negligible losses when the market is rising, whether they're footballers investing their money in the asset or really widows and orphans. I mean, it's really, it appears quite an easy business, and unfortunately, the banks have been suckered into lending to people they certainly shouldn't have been. And that, when they go out and chase business, which is what they do in each of those big upturns that I have observed. And I think you need to be especially beware of managers who have not seen a big cycle before. And this, I think, is where, if there is an explanation for the sort of the 15 to 20 year cycle, and like the one I think that is most helpful or is most real is the one about memory. That period of time is just long enough to get to a position of seniority without having seen one of these cycles before. In fact, the head of one of our banks, UK banks, exactly qualified. The head of HBOS, I think I've strategically forgotten his name, but joined the bank. It was about 35 when he became the CEO of that bank. In fact, his experience was really as a retailer. But he had no, unless he'd really, I mean, he was a bright guy. His career is still going. But that in terms of people not learning and it's very hard to learn from other people's mistakes. You really, as I think we probably all know, we've all been told not to do things and promptly go and do them, often with adverse consequences. Learning from your own mistakes is a lot easier than learning from somebody else's. But these have serious consequences, and that is what we need to do. So property values, when they increase by over 25%, when we get up to that critical level, within a 2 to 3 year period, certainly based on what we've seen, there's a very high probability that we're going to see a bust. Some other things were exploiting the property cycle, which I wasn't intending to talk about, but if you wanted to come back on to me in relation to that over questions, perhaps we can. So, coming towards the end. When will the next big cycle occur? Well, it's pretty easy, isn't it? It's going to be 17 to 18 years beyond the last one. So that takes us to 2025, the middle of this coming decade. What more do we need to think? Certainly, it's going to be time for people to get to positions of seniority without experience and make the same mistakes we've seen all over again. We're already seeing the debt market attracting new players into it who don't have any institutional memory. But of course, one of those new players is my own old firm. LaSalle has been in the debt market most of this decade. Hopefully, LaSalle does know something about property markets and won't be suckered in the same way that perhaps the banks have been in the past. But the incentive, the easiest thing to raise money for is something that has been profitable. Something that has worked and delivered. And the returns from debt funds at the moment, is excellent. And certainly when you look on the risk-reward spectrum, inevitably that's quite a bit of judgment in relation to that. That's probably as good a place on the risk-return spectrum to be in the present market as there is. That is, the ability to raise money for something is going to continue to be something that is going to drive the growth, and maybe it will take us to dangerous levels. The last point is pretty critical, though, is will the Bank of England or the central bank regulators do what they're meant to do and take the punch bowl away before the party gets out of hand? They singly failed to do that in 2005-06 and in 1986-87. I'll let them off in the very early 1970s because, in a sense, it was a slightly new phenomena. And in fact, actually, the Bank of England at that time was on a crazy pumping money into the system anyway. Will they be sufficiently brave? Will they be sufficiently politically confident to remove that punch bowl? We can only wait and see. But there are a number of cons as to why this next cycle should be so simple. Principally because the 2008-09 crash was absolutely devastating. That its effects are still being talked about now, 10 years later, over 10 years later, that the memory may linger longer. Certainly there's better education, there's information about real estate markets, a report put together about property vision, by a group from the Investment Property Forum in the UK to try and help the Bank of England set some things out. They may be there to help in relation to that. And then certainly the Bank of England is taking a lot more interest in commercial property research, and we'll come back to that in just a moment. But perhaps as importantly, the recovery from the GFC is proving really slow economically. Where is the confidence going to be to actually generate a boom that would create a bust? And certainly there's no question to my mind that this decade is the closest that we've experienced to the 1930s, which is quite a sobering thought. And one piece of evidence, again, we've got a long piece of history to show off in a way, real wage growth in Britain since 1209. Why 1209? Don't ask me, but that's when the data starts. This is a series on the Bank of England website which has been developed. But what I wanted to show you was the Brits on average are worse off today than they were in the global financial crisis. Wages are beginning to rise, real wages are beginning to rise a little, but this is something that hasn't really happened on a consistent basis since the 1860s. And this is not probably exclusive to the UK. Average wages around the world in a lot of markets have stagnated pretty seriously. And this is hurting. This is affecting trust of elites. It's certainly not helping our politics. But going back to that point, in terms of getting a recovery that is going to have enough oomph to create a boom at some stage, we're really due the end of a business cycle for the global financial crisis, and then the next one would coincide with a property boom. And the Economist, I think he reported yesterday, that the US has just entered its longest ever upswing. It's been a pretty weak one, but it is the longest. So those cycles, certainly are moving much more slowly than they have in the past. And of course, this is one area where Brexit could well have an impact. Whatever it's going to do, it's going to slow our economy in some way or other, again. So that there are good reasons for thinking, I'm pretty confident, we won't have a property boom and bust before 2025. Probably will be later. But there will be one, but it could be quite a lot later. Just going back to the Bank of England, they've now started in their annual financial stability report to include something on property values, how over or underpriced they are, really using work that Neil Crosby, who's known to many of you, has done. But the bank does have a specialist on commercial real estate now, which again is unheard of. And I'm involved that some work is being done, financed by the IPF, being done at Cambridge and Reading, looking into long-term valuation methodologies really at an all-market level. And that work should come out in the autumn. And the Bank of England are actually on the steering group with that. So they are showing a lot of interest in what is being done. So, to conclude, the past, property cycles have a very long history. My 4 phases, most are pretty obvious, but the recovery is really interesting, particularly, again, if you want to exploit it. And what are the causes? Well, clearly it's a combination of economic, debt availability, development, and I would include memory in there, perhaps more controversially. Today's market is really has been an equity-driven upswing, but not a boom, driven by pretty low interest rates. So the market is going to remain, I would say, in rough equilibrium. There won't be a bust. And certainly debt levels at the moment are quite manageable. In fact, the clearing banks have been reducing their debt. And as I say, the future, certainly in the next decade, we're due another boom and bust, a big cycle. It certainly isn't inevitable to be around 2025. I'm pretty confident it won't be before. It could be a little bit later. But I think everyone has to be well aware of the very wise words that the late Alistair Ross-Gooby had in his book, Bricks and Mortals. If you want to try and buy a copy of that on Amazon, I think it costs you over £1,000. It really is quite rare now. I wish my book, that is a bit older, was worth anything like that, but no, it isn't. But he's written, well, you can read it, but this point on memory, the people who have not seen the cycle seem to repeat the mistakes. And of course, he wrote that in 1992. And exactly the same thing happened 15 years later. And it will happen again. The question is precisely when. So, thank you very much.